The following is paid programming. Welcome to Something More with Chris Boyd, certified financial planner practitioner and founder of Asset Management Resources, LLC, a registered investment advisor firm. We call it Something More because we like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients across the country, your host, J. Christopher Boyd.
Hello, welcome to another edition with Something More with Chris Boyd. I'm Jeff Perry sitting in for Chris Boyd this week, and I'm very happy to have on us this week again Brian Regan, who's a certified financial analyst with Asset Management Resources. Brian, thanks for joining us for another episode. You're one of our most frequent guests, and we appreciate you taking the time out of your busy schedule to share your insights on all things financial, economic, markets. Thanks for joining us.
Good to be here as usual, guys.
Certainly a lot's been on the news. We're recording here in mid-October, and we have done an episode already recently talking about the crisis and attack on Israel. So I tell the listeners that because if you're listening on a podcast in the future, in some of the comments that we're making about Israel, I want to put it in the context that we are in the same week that Israel was attacked. And if you'd like to listen to the episode that we talked about more specifically about Israel and the geopolitical events, check out our podcast at your favorite place that you listen to podcasts, whether that be Spotify, Apple, Amazon Music, wherever you listen to your podcast. You can check out, just Google Something More with Chris Boyd and you'll find those podcasts. Brian, I wanted to talk today about, certainly I want to focus on the markets. Usually when I say the markets, we're talking about the stock market. And I think that gets more people's attention historically when we just say, let's talk about the markets. People think about the stock market, but the bond market is telling us a lot of things lately. We touched on it on previous episodes. But what do you want to focus on? What's going on? Let's start with the 10-year. What's going on with the 10-year, and what is it telling you about inflation? What's it telling you about the economy, the risk of recession, wherever you want to start?
Sure. So when we talk about I hear what you're saying, but I do want to make one point. When we talk about the stock market, we can't think about it independent of the bond market.
An excellent point.
You know, I say time and time again that the pricing of stocks is a function of earnings and interest rates. And, you know, the interest rates are the bond market, right? It's the benchmark treasury rate really plus some kind of spread. So if that's your lens on how you view stocks, which it's the lens on how I view stocks, then, you know, there's a huge 50% of the pricing in the stock market, at least, is going to be a function of the bond market. So
I completely agree, and the reason I framed it that way was when the average listener, not a financial analyst, not an investment advisor, but when they tune into CNBC, or most of the talk is about stocks. If they happen to be watching their evening news, they get the update on the stocks. The news is talking about the stocks and going up or going down, and all the business news is focused on stocks. So that's why I wanted to clarify when I was saying markets. We usually think of stocks, but you are 100% correct that we have to think of the bond market as well.
Yeah. So what's going on in the bond market? Well, we've seen just an unprecedented, and it seems like we use that word a lot. It's true.
Sadly, we do, yeah.
Just surge in the 10-year treasury rate. Now, I've always been concentrated on the 10-year treasury rate. It was one of the reasons why maybe at the end of 2022 I was less concerned about stock market than maybe some other folks, and that's because the 10-year treasury was flatlining. Which was good, right? The Fed funds kept going up, but the 10-year treasury, stayed flat. And why do we concentrate on the 10-year? Well, stocks are long-term assets, so we should look at long-term bonds when comparing stocks. It's really that simple. So this is kind of the academic way of looking at it. It's how I think about it when I think about fair value. I don't know if it has any semblance on short-term moves in the market, but it certainly has recently, as the 10-year has just surged. So we should talk about why it surged, right? So 6 months ago, the 10-year Treasury was at 340, call it, and the 2-year Treasury rate was at, call it 4, right, rounding up. Yep. So it's a 60 basis points difference. That's called an inversion. Now, an inversion is not the natural order of the bond market. Typically, you would expect the longer you lend somebody money, the more return that you would expect to receive. This is called the term. This is called the term premium. So this is why the bond market is typically upward sloping. So when we talk about an inversion, this is what people are talking about. And when people say it's a harbinger for recession, historically it has been, but it also is because there's obviously not a lot of demand to lend long term when the rate you're going to get is not very attractive versus lending in the short term. So it's almost a cause and an effect when it comes to recession expectations.
Kind of a self-perpetuating thing, right?
Right. So you would expect that to fix itself over time. Now, there's two ways it can fix itself. The more common way is for the short-term rates to come down, and that usually means that there's a weakening economy, the Fed's being very dovish, and that would come down below the 10-year rate. The other less common way that it could happen is that the longer-term rate could rise above the short-term rate. Now, we still have an inversion. We still have a significant inversion, but it's less inverted than it was 6 months ago, and certainly 3-4 months ago. So, that's one reason. Now, the biggest reason is the economy has been on fire in the third quarter, and that has led the Federal Reserve to make their expectations they're going to be higher for longer. And the market's actually taking it that they're going to be higher for even longer than their dot plots would suggest. So their dot plots suggest that they're going to start cutting, and by 2026 or so, they're going to be down at 2.5% as the terminal rate, right? So 2026 is only 3 years from now. You would think that the 2-year rate, for example, would reflect cuts. Well, no, the 2-year Treasury is still well over 5%. They're basically, the market is saying the Fed is wrong. They're going to be even higher for longer than they expect, which is consistent with the Fed's track record. Actually, the Fed's typically been a little bit more optimistic than reality, and that's what's happening. So we've seen the 2-year rate go from 4 to 5. Mathematically, about 35-40% of that should affect the 10-year. So as we've seen the 10-year go from 340 to 470, let's call it. Mm-hmm. That's 130 basis points. About a third of that can be explained by the change in Fed policy. Okay. Now, we've also seen expectations for growth in the economy go from about 0 to about 2.5% higher for the third and the fourth quarter for the year. You could tack on another 30 basis points for that. So now you're at about 70 basis points in change based on Fed policy, expected growth. Now, tack on another 25 basis points because inflation expectations have surged in the last 3 months, and partly because we've seen a big increase in energy. And by partly, I mean that's the only thing that I can see from my estimation that's changed, because inflation in general, specifically core inflation, has been on the downfall. And certain adjusted inflation rates are between 0 and 2% right now. So inflation does not seem to be a problem, but the market seems to think that it could be a problem going forward. So now we're near 1%. We're in the ballpark of the change in rates, and it's because of change in inflation expectations, change in growth expectations, and change in expected Fed policy. Now, that's a dramatic change, and I think if growth reverts to the mean, you'll see the expected Fed fund policy also come down, and you could see a big unraveling as growth in the United States normalizes. Of course, that's an if, but I think it's a reasonable expectation.
So let's shift gears, but still staying on the general subject. I've seen a lot of commentary lately about the increasing debt of the United States and the deficit in the budgets and the fiscal problems that we are having and the cost of that debt because with higher interest rates, we're talking about treasuries here. And so the treasuries had to pay higher rates on all these bonds, whether they be short bonds or all the rates have been going up. So the cost to the United States to service this debt is growing. And then there's the discussion about with the increasing national debt and the ongoing budget deficits that the Treasury is going to have to issue more treasuries to fund these growing debts. Now, I'm not trying to get you down the discussion which we've had before about is the debt concerning as a percentage of our gross domestic product? That's a separate discussion. But do you view the growing national debt and the need to issue more treasuries and the things that you just, we're talking about potentially declining treasury rates? Do you view that the Fed's going to have troubles declining the rates or that the interest rates are going to have to stay higher to attract buyers for our debt? And I'll throw in there that there has been some recent data and news about China, who owns a lot of our debt, a lot of our sovereign debt, decreasing their exposure to the United States. So do you look at these things when you're thinking about bonds and think of the influence? And do you think it's a significant enough of influence to calculate into your projections, China owning a lot of our debt and potentially the need to keep the rates higher to attract buyers?
So
I know that was a lot.
From 2010 to 2020, there was not a real interest rate on the 10-year, meaning, if you adjusted for inflation, the yield was zero or even negative.
Right.
And there's a host of reasons for why that is. First of all, inflation was very low, so the Federal Reserve's policy could continue to be extremely dovish. But at the same time, we might have had zero real rates, but around the world, there was negative real rates in a lot of developed countries.
Sure.
There's still negative real rates in a lot of countries, but almost everybody has a positive nominal rate. So if you're an investor in Japan, for instance, one of the first times ever, and Japan is, I believe, the biggest foreign buyer of our debt. For the first time ever, you're getting a positive real yield, not first time ever, but first time in a long time, positive nominal yield. So you could reasonably invest in your own currency's debt rather than a foreign currency's debt, which is attractive. And this is happening in Great Britain. It's happening in Canada. It's happening in the Eurozone. So that is a significant change to your point. So I don't know necessarily. I've seen a lot of evidence of, except for maybe recently, of deficits being the issue. But I can certainly see that now there's a significant real yield to be had. And I think part of it is because of developed nations having positive yields for the first time in a long time. The United States has to compete against the rest of the world.
Sure.
I think despite the deficits, we still have a structural advantage in many ways. And you could see that as the dollar and the yields, still react very positively, as in yields going down and the dollar going up when we have something like the Israel-Hamas conflict. They still consider that flight to quality there. So if there was a big concern about debts and servicing the deficit, I think that the rate would be completely out of control. I don't even think the Fed could be able to control it under circumstances like that. So not to say that the deficit isn't a concern, not to say that the national debt isn't a concern, but is it at the wheel driving yields right now? I don't think so. I think it's a function of Fed policy, growth, and inflation still.
Okay. Well, let's go back to you briefly discussed the inverted yield curve and talked about your view of it moving forward and what may happen and the consequences of that. I guess I don't know how long ago it was. Whenever the yield curve when inverted, we're talking about that it's typically a sign of a pending or a future recession, right?
Mm-hmm.
So we haven't seen that recession. So do you have a different view? I know your views on the recession, but do you have a different view as the inversion of the yield curve being a predictor of a recession? Do you think that's still in the cards, if you will?
I think it's still possible we could have a recession.
Mm-hmm.
The yield curve's still inverted. Historically, we go into recession when the yield curve starts to steepen.
Mm-hmm.
So, I'm not the person that thinks we're out of the woods at all. I mean, it certainly could still happen. I mean, when you look at the NFIB data, which is a small business survey data,
Right.
which is typically pretty well correlated to the 10-year, you're seeing a decrease in hiring and hiring expectations. We haven't seen that in continuing claims yet. We really haven't seen it in initial claims yet. Those are still very, 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 very good. The unemployment report that we just got was very surprisingly good. So, these things haven't happened yet. But, coming back to the debt market is the market to pay attention to. Companies aren't really forced to lay people off until their business is in trouble, right? And when your business is in trouble, when you have to refinance your debt or you have to pay your debt, and to that point, I think we're going to start seeing, continue uptick in bankruptcies and spreads on, high yield debt. So I would continue to caution people to be careful. I don't. You shouldn't have the pedal on the metal tactically. I don't think that you should be, scared to death either. But again, you should probably be somewhere around neutral, and allocating your fixed income in a very advantageous spot where right now we're getting the highest yield for taking the least amount of risk. If you got excited about a rising longer term rate in 2020, 2022, well, you really regretted extending your duration here in 2023. So, be disciplined. Be disciplined is my message. Just stick with the long-term plan. Don't get out in front of your skis and wait for the market to come to you.
You mentioned high yield debt. In the past, recent past, we've had some conversations with you and Chris Boyd about avoiding that market because the spread between, say, treasuries and the high yield, meaning higher rate of return but higher risk, hasn't been sufficient for the amount of risk that you could take with a high yield investment. Has any of that started to change for you, or are you still thinking that the high yield market is something to avoid?
We've had a recent uptick in high yield spreads, but nothing to write home about. So yeah, I mean, I'd continue to be cautious about it. I'm really concerned about, the maturity in the unsecured high debt is gonna triple in the next 2 years, and these companies are going to have to refinance that debt at higher yields, or they're going to go out of business. And what's going to happen is both those things are going to happen, right? And the companies that continue to exist are going to be able to earn above that cost of capital, and the rest will go bankrupt. And that can be a healthy thing, right? I mean, there's something called zombie companies that are basically existing on really, really cheap capital. And we've already seen that they're starting to filter out of the market. And, that could be tough for equity holders, especially in small cap markets. But for the generally speaking, for the economy, I think it could be a good thing as resources get allocated to more profitable ventures.
Brian, we only got a couple minutes left for this segment. We started off the show talking about markets, and we had a little back and forth exchange about, wait a minute, we're not talking about the stock market. That's kind of how I was looking at it. Like, people hear markets. You correctly pointed out that the bond market greatly impacts the stock market, and you have to think about the bond market equally at the same time. So let's end the show with we've talked a lot about the bond market. Now let's go back to the stock market. Your view and your beliefs of where we are in the bond market and what's likely to be in the future here, or the immediate future. How does that translate to your view of the overall stock market valuation?
Earnings are expected to grow rapidly in 2024, and they're supposed to trough here in the third quarter reporting earnings season. If that happens, if we have 12% growth in the next 2 years, we're probably going to see a very healthy stock market. If that doesn't happen, the stock market could be in trouble. And this sounds very unprofound, right? If
earnings fall, the market falls. If
companies make money, then things are going to be great. If companies don't make money, then things aren't going to be so great. But if the market was trading at 3,500, I wouldn't say that we need to hit this really high bogey on earnings for the next couple of years, right?
Yep.
The expectations would be less, or the hurdle would be less.
Mm-hmm.
But the hurdle is high, and the hurdle has to be high, right? Because when you have 5% long-term Treasury rates, let's say the equity market's going to want some kind of spread on that. Let's call it 2%. Where the equity market might have demanded 4%, now let's say they're demanding 7.5%. Well, the dividend, if you're in a slow-growing dividend stock, your dividend yield better be over 7.5%.
Mm-hmm.
If you are in higher growing stocks, well, you better grow your earnings by more than 7.5%. In that case, it might even be more, right? So the hurdle, the expectation is 12% right now, which is why I think we're seeing some optimism in the market.
Mm-hmm.
And I really hope that happens. But if you want to talk about positioning, we are underweight stock. We're underweight beta. My goal is to keep pace with the market if things go well, and give a little bit of a cushion if things go south. That's how we're positioned right now. So I think that just tells you that I'm hopeful but pessimistic about reaching this hurdle. And I don't like to use the word pessimistic. I think generally I'm optimistic.
I think
keep in mind that 12% is it's like 35% higher than the long-term average.
Right.
So if you just think about it that way, it's statistically, historically, a hard hurdle to beat.
Thank you, Brian. And as the earnings season develops here, we'll certainly have you back on to talk about how you view the earnings as they come in and after they come in. And we have some inflation data coming out. Always lots of things to talk about. We sincerely appreciate your time and your perspective.
Thank you.
Please join us for our next segment when Chris Boyd will be back. Until then, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's financial planning, portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at amrfinancial.com or call us toll free at 866-771-8901 or send us your questions to radio@amrfinancial.com.
You're listening to Something More with Chris Boyd, Financial Talk Show.
Asset Management Resources, LLC, and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR, LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.